Here we have the hourly price chart for Apple Incorporated, stock ticker AAPL. Here we can see that Apple is trading under some selling pressure to start the trading session. This is fairly common throughout the market at this point, especially in the tech space. We're seeing quite a few names trade under pressure at the moment. So currently, we're trading at the lows at the current moment here at the time of video, with lows posting out 228.23. We are continuing to grind lower here after posting highs just above the 233 level. So these moves are significant for a few different reasons. I mean, one is the fact that we are seeing kind of a broad-based sell-off here, especially throughout the tech space. This is likely to continue weighing on the S&P 500 and the Nasdaq indices. This does look like it could be a fairly substantial move here to close the week. We may still be in the early phases of this. At the moment, what we do need to point to here is the fact that share prices have already broken through their 20-period exponential moving average. That's this yellow line here. So this is the hourly chart. So what we're looking at here is, each candle represents a 1 hour trading period. So the yellow line here represents the prior 20 hours of trading, the average, the exponential moving average. So currently, this is significant because we are breaking through this level. And if we're looking at this most recent uptrend activity here, a top here would be significant, and it would allow us to start doing some Fibonacci analysis based on these price zones. So if we're looking at these areas here, what we can see initially is that, the first Fibonacci level comes in at roughly 227.70, just below there, which would this area would mark the 23.6% Fibonacci retracement of this latest trend move higher, this latest bull wave. That would be this red zone here. This would be the initial area, and we've already lost the 20-period EMA. So it does not really look like this Fibonacci zone alone is going to be able to hold up prices from here. So for this reason, if we do see a break below this level, I would absolutely be targeting the 38.2% Fibonacci retracement, which comes in at 224.34. What's most significant here is the fact that we do have a prior consolidation zone. We have a bit of support here in this area. And then in addition to that, we do have this rising orange line here, which would be the 50-hour exponential moving average. So you can see these areas come in relatively close alignment with one another. It's just a coincidence here that they're both orange. They don't have any special significance other than that. But we are seeing these two areas cross over into the same region. And this does suggest that there would be a strengthening of the level of support that would be likely to be found in this area. So overall, this is kind of my downside target here, because we do have three different factors here influencing prices. That would be the historical support, the rising exponential moving average, and then the 38.2% Fibonacci retracement zone. So if we kind of pull out here a bit, we can try to get an assessment of what this broader picture actually looks like. We are seeing a bit of some varying activity here in the indicator readings themselves. Below here is the relative strength index. That's the purple line. The yellow line here would be the average of the relative strength index itself. And as we can see here, we have some conflicting signals. So first, what we have to note here is the fact that a prior trend in downside momentum has broken recently. This occurred during the July 3rd trading session, this downside break. And we have started to see some emerging bullish uptrend indicator movement here. This hasn't been reflected in prices during these most recent trading sessions, but this is likely due to the fact that the indicator reading itself has crossed below its own exponential moving average. So we can kind of zoom in here and take a look at that. Okay, so as we can see here, the share prices themselves did move into overbought territory and somewhat heavily overbought. I mean, we were above the We were above the 80 mark. The relative strength index does operate on a scale from 0 to 100. Anything above 70 would be considered to be overbought. Anything over 90 would be considered to be extremely overbought. So we didn't quite reach into that region, but 80 is an elevated reading. I mean, it's a significantly high level, and it does suggest that prices need to see some sort of downside corrective pullback, or at least a period of sideways consolidative trading, in order to kind of allow that indicator reading to reset itself. One of those two things can happen, but you're less likely to see prices continuing to move higher under those types of circumstances. So one is the fact that, one point that needs to be made here is that we were trading in elevated territory here. 80 is a high reading. So we did move into a highly overbought region. And then in addition to that, you can see here that the relative strength index, the purple line, crosses strongly below the yellow line, which is its own moving average. This is a bearish signal on its own. So, we do have kind of two separate indicator readings here telling us that that prices are likely to move lower. The real question here is whether or not this can continue, because the broader trend momentum here is positive, and it's roughly in the current region where you would expect this trend to sort of resume itself. So, if you were being a bit adventurous here and you wanted to take a long position, you could wait for a bit of an upside price movement here in the relative strength index, and then possibly a bounce from this 23.6% Fibonacci retracement level, targeting the prior highs just above 233. I personally would not do this because there's just not enough support here in this region. This would be roughly 227.90. I would like to see a few more indicators here pointing to this region in order to start establishing long positions here. Much more likely, I think we would be much more likely to see a bounce near this 38.2% Fibonacci retracement, which does come in at 224.34. The only problem at that point is going to be the fact that it's much more likely that we will see a downside break of this uptrend momentum reading in the RSI and the relative strength index. So, we will have to come back here and take a look at what the RSI itself is actually doing if we do fall deeper toward these levels. So for these reasons, I would probably stay on the sidelines here for the moment. I wouldn't trying to be catching this move at current price levels. I would probably be waiting for another decline of at least $4 per share. Or thereabouts, maybe slightly less than $4, and then I would consider new long positions as long as there's still a favorable reading here in the relative strength index. So this is the current market analysis for Apple Incorporated, stock ticker AAPL.